needed to sell a bond for whatever reason. They were distressed, and they decided to sell this bond. And particularly if they're distressed, they may take any price they can. So that price may not represent reality for someone who's not distressed. So it's hard to get an estimate of bond prices for bonds. So what we typically do is just use book values. You go to a balance sheet, you look at a firm's total outstanding debt, and you use that as our proxy for the level of the firm's debt. Here I'll just use it because I can make up the numbers. All right. So and in terms of total value, we just add the two. We add the debt plus the equity, right? That's the total value of the firm's assets. And then we come down here and just take the ratios. WE represents the percent financed with equity, market value of equity over total. WD is market value of debt over total. And I've already talked about the taxes issue here. Again, it's all just a function of the U.S. tax code. Right? So let's do an example, a weighted average cost of capital of debt. I've got two examples here. I'll run through one. I have one for you to take home and play with at home. I'll give you the answers. So this is what the firm looks like. We want to know its weighted average cost of capital, information on its equity, has 50 million shares outstanding. Each of those shares costs $80. The firm's beta is 1.5. Market risk premium is 9%, and risk rate is 5%. On the debt side, they have 1 million bonds out. Each has a face value of $1,000. They're trading at a premium right now, $1,100. Coupon rate's 9%. They have semi-annual coupons and 15 years to maturity. And this firm has a tax rate of 40%. Right. So the question is, what is the firm's weighted average cost of capital? All right. So we're just going to run through all of the different inputs. Right, a way of review. Again, cost of equity, we're going to use CAPM. We said the risk-free rate was 5%, beta was 1.15, market risk premium was 9%. That spits out a cost of equity of 15.35%. Cost of debt, well, again, we have 15 years until maturity, semi-annual bonds, and these are 30 semi-annual periods. Right now, the bonds are trading at $1,100. Have a face value of $1,000, and their coupon rate was 9%, which again was semi-annual coupon payments. Gives us a semi-annual coupons. That gives us a semi-annual coupon payment of $45, right? 9% divided by 2, multiplied by the face. Okay. So that our calculator spits out the following semi-annual discount rate, but because the yield to maturity is always annualized, we double it to get a yield to maturity of 7.85%. We're going to multiply that by 1 minus the tax rate to get the after-tax cost of debt, because that's all the company cares about, right? They're going to get each of those interest payments they send out, they get a write-off. So what they care about is their effective cost of debt, which is 4.7%. Okay. Last thing we have here, capital structure weights. We need to know the market values of equity and debt. For the equity, we take up the number of shares out at 50 million times price per share. That gives us a total market value of equity of $4 billion. Debt, take number of bonds times price per bond. It gives us a total of $1.1 billion on the debt side. Add those together, we have a total firm value of $5.1 billion. All right? And then we look at the ratios. On the equity side, about 78% of the financing of the total value comes from equity, the 4 divided by the 5.1. And then on the debt side, you have the residual amount, 1.1 divided by 5.1 gives us about the 22%. All right, so about 3/4, 1/4 here for this firm in terms of their financing. And then we pull it all together for the weighted average cost of capital. We take that 78% on the equity side multiplied by the cost of equity, plus the 22% times the after-tax cost of debt. And we find this firm has a weighted average cost of capital of 13%. And then what we would say is, okay, now if we're looking at evaluating projects for this firm, and we'll talk about in a minute the assumption we have to make to use the weighted average cost of capital, but assuming we make that assumption, that weighted average cost of capital becomes our discount rate. Right? That becomes the discount rate we use for that firm's projects where the risk is. Yeah. Yep.
Earlier we talked about IRR, right?
Yep.
So our IRR has got to be close to that number. Right?
This becomes the hurdle rate. Right? So again, yep, that's right. So that becomes your hurdle rate, that's your cost of capital. And if you're about to use the IRR rule, the IRR has to be greater than that, right? Okay. And again, there is, I do want to, we'll come back to a second, but we're making an assumption when we use WACC, but we'll talk about that in just a second. Any other questions? No? Okay. So here's one again for you to take home, practice with, just make sure everything is working. Let me give you the answers here, so just so you can check yourself. In this problem, you should estimate a cost of debt around 4.48%. 4.48%. That's pre-tax. And then you should get an RE around 16%. And you should get a weighted average cost of capital of 9.77%. Okay? So check it out, practice. If you don't get that, let me know, you can figure out why. But cost, again, pre-tax cost of debt, 4.48% around there. Cost of equity is 16%, and a WACC of 9.77%. Let me give one heads up here. We did this on purpose. When you're doing the cost of equity, I've given you the expected market return, not the market return, not the market risk premium. Okay? So again, this data is being delivered in the alternative form. So you've got to account for that when you're doing your CapEx calculation.
On our annual payments.
Okay, so now, when is it appropriate to use the weighted average cost of capital as our discount rate? We've kind of been leading up to this. Well, it's only appropriate when the projects you're evaluating have risks that are similar to the risks of the firm overall, right? And that makes sense because think about how we came up with the weighted average cost of capital. We didn't derive this at the project level. We derived it at the firm level by looking at the firm's stock and the firm's bonds, right? All we can tell from that is how investors assess the riskiness of, or the appropriate return for, holding the firm's stocks and bonds, right? It tells us nothing about what they would want for an individual project. So to the extent that the project you're evaluating has risks similar to the firm, well, then the weighted average cost of capital tells you what investors want as a return. But if the firm is doing something totally new, totally different, right? Well, the weighted average cost is not appropriate. Because it tells you nothing about the appropriate return given the new risks that you're taking. Now, those new risks could be higher or lower, right? You could be some very conservative firms we were talking about earlier, maybe some like New Heritage Doll Company firm, and they want to do something very risky, right? And what we discussed, it looked like the, what was it, 8.4%, that moderate risk number, whatever it was, that looked like kind of like the firm's overall kind of discount rate. And for DYOD, a lot of us said, well, we want to use something higher than that because we think the risks are going to be higher, right? And we only had one choice there. We didn't estimate it. We had one choice there, right? But the key idea is you can only use the WACC if the project's level risk is similar to those of the firm overall, okay? And again, some examples, maybe an expansion of an existing product line, like the MMDC, right? You have some product you're already working on, you're just extending it, or maybe into a new market, or replacement projects. If you're looking at a project that has risk different from the firm, you got to do something else, right? And we don't have the time to go into what all these can be, but you could think about this if you're going into a completely new line of business. Well, maybe you could find another firm that's in that line of business, or what would be even better, a collection of other firms that are in that business, what we call pure play firms that do what you want to do, right? And look at what is their weighted average cost of capital, and take some average or median or something like that, right? So if you thought like, if you think about Apple, and Apple decided to make soup, which I guess would be the iSoup or whatever, but I dropped the I a lot now, it's Apple Soup, I guess we call it now. And they want to make soup, well, you can't use Apple's weighted average cost of capital, it'd be way too high. Right? Soup is as we saw last week, it has less systemic risk than gadgets, right? So I might want to go look at Campbell Soup or something like that and look at what their weighted average cost of capital is before I go and evaluate the projects. Right? Now, in practice, people always, actually that's very too straight. In practice, people wonder, I guess, does it matter? Right? We spend a lot of time talking about this, finding your WACC, and many times it's, well, look, my firm's WACC is 10%. We just use 10%. That's what we use. Right? Does it really matter if we make adjustments or think about this? And as academics, in teaching this, we've always said, yes, it matters, right? But we want some evidence. Well, a new study has just come out that shows, yes, it does actually matter, right? And so I have something to show you. Okay. That's not it. That's not it. Because show me my other thing I want to show you. All right, it just doesn't matter.
We'll take your word. Take your word. That's what you said.
Because I said so. That's how I teach my children. Okay, so here's the picture. So this is a study that's coming out in one of the top finance journals. And what they wanted to look at here, this is just one chart that kind of illustrates the point. They wanted to look at mergers and acquisitions, because these are big investment projects that firms do. And not only the big investment projects, we can actually look at what the market thinks about this. So when a firm announces a merger and acquisition, the stock of that firm reacts, right? Typically, if they like the deal, it goes up. If they don't like the deal, it goes down, and so forth, right? And so what these authors wanted to look at is they looked at the relative WACCs for what we call the bidder and the target. So the bidder is the buyer and the target is the seller, right? And so they want to say, well, let's look when these are different, right? Because then that would indicate, maybe we could see, if, so in the case, this solid black line here, this is when the weighted average cost of the buyer is less than the target. And let's just make this assumption that people are lazy, okay? So it's not difficult to calculate a WACC, right? We just did it, right? It's very straightforward. But the lazy thing to do is just use your own, right? It's just say, like, our WACC is 10%, theirs is something else. But I don't want to think about it. It's just easy to use ours, right? So in the case here, where the weighted average cost of capital of the buyer is less than the seller, we should be using a higher discount rate, right? But we decided to be lazy and just use our own. What happens to the valuation of that firm we're buying if we just use our own rather than theirs? Does it look more attractive or less attractive? But our discount rate's lower. We should be using a higher one, but we chose to use a lower one. What happens to that valuation we're looking at? It makes it higher, right? We've used too low of a discount rate. It makes them look better than they are, right? And so that's exactly what we find in the data. This black line says, in those instances where all we've done is condition on the differences in weighted average cost of capital, this 0% means this is how the market reacted. 0 means the market goes, whatever, right? Look what happened. And the timing is 5 days before to 5 days after, so we can look over time what the market thinks. In those cases where they use the wrong discount rate and it made it like something look too attractive, the firm loses 2% of its value. Right? The market's like, what are you doing? Right? And that's a pretty big jump here. When it's the other way around, right? When the buyers is higher than the sellers, the market's just kind of like, oh, it is what it is, right? It's not that big a deal. What we really care about is the difference between these two, right? The fact is when you're lazy, you do the wrong thing, you destroy value. And how much value? If you look across all the acquirers in the sample, it's $100 billion of value that was destroyed by just using the wrong weighted average cost of capital.
How much?
100 billion.
Billion.
Billion across all of the acquisitions, right? So that's at an aggregate level, right? Across all the acquisitions, $100 billion was destroyed because people didn't do what I just showed you a minute ago, right? No, that's over the sample period, right? Now the other thing that doesn't account for is the reverse effect. All those deals where on the other side of things, I use my discount rate, which was too high, versus yours, right? If mine's too high and I use it upon you, you don't look so good. I should have used a lower. It's like Apple with Campbell's soup. If I use my 15%, I should have used 7%. I don't even do the deal. The deal doesn't get done. We don't even get to observe it because there's all those times where you go, well, yeah, I guess strategically it sounds good, but the numbers don't work out because I used too high of a discount rate. So this misses all of those kind of like false negatives or something like that, right? And then it gets left out. So in the real world, there are real consequences for using the wrong discount rate. And when we see these differences here, they're not huge. We're talking about differences between 10%, 11%, 10%, 12%, something like that. But they matter. We say, again, in aggregate, about $100 billion of destroyed value across the market by doing it. So it does matter, and it's not hard to do. It's just thinking about, again, what's the right thing to do. All right. So we're going to make, for our purposes, again, when is it appropriate to use WACC? It's when, in the context of that example, it's when that selling firm has the same exact weighted average cost of capital as the buying firm. Then you can use your own. It's perfectly fine, right? And we're going to maintain that assumption throughout. So for all the projects we're going to look at, we're going to assume the level of risk in the project is similar to the risk of the firm overall, so we can use the weighted average cost of capital. All right? So that's going to be our working assumption. right? All right, so one last thing I want to do here again, just a complete capital budgeting problem, right? So we're going to run through doing, again, cash flow calculations, discount rate calculations, and pull it all together to come up with a net present value to make a decision, okay? So we've been hired as a financial consultant to Defense Electronics, Inc., a firm that produces radar detection systems. The company's looking at setting up a manufacturing plant for a new line of this product. And we're given a ton of information about this. Again, it's all in your notes. We'll just run through it, and then we'll kind of use the data. It's going to be a 5-year project, so like it's a terminal project. And again, this is kind of the key part. It has risks similar to those of the firm overall, so we see that we know we can use the weighted average cost of capital. The plant will cost $9.8 million to build, and the firm will depreciate using 3-year MACRS depreciation schedule. At the end of the project, DEI can sell the plant for $1.25 million. The project requires $825,000 in additional working capital. We'll recoup that at the end of the project. Plant's expected to generate $4.11 million in operating cash flow each year. We know a little bit about the firm's financing. They have 25,000, 6.5% coupon bonds outstanding. Each of these bonds has 20 years to maturity, makes semi-annual payments. They're selling at a discount for $9.60. 400,000 shares of their stock. Their price is $89 per share. The beta is 1.2. And in the market right now, their expected market risk premium is 8%, and the risk-free rate is 5.2%. All right, so here's the question. Given the firm's tax rate is 34%, should they build a new plant? Should they go forward with this project or not? Well, we know, again, before we jump into it, we know the framework. To evaluate this, we need to calculate the net present value, right? That's going to be our kind of our baseline, right? If it's positive, we'll accept it. So that's our framework. We already know kind of that's our decision model. Positive NPV, we'll go forward with it. We want to evaluate it more, but that's kind of the base response. And then what do we need? We need cash flows and we need a discount rate, all right? So we're just going to, again, walk through calculations, all right? All right, it's a 5-year project, and this is just kind of a review of things that we've done. It's a 5-year project. Upfront cash flows, well, it says we need to spend $9.8 million on the fixed assets and another $825,000 on working capital. Years 1 through 4, we have OCF, which we were given directly. We have to calculate at $4.11 million. And in the last year, again, we still have $4.11 million of OCF. We're going to give back our working capital of $825,000. And we have a salvage value of $1.25 million. And we look for any taxes on this, and we indeed we do. We have depreciated it fully, right? Which means when we sell this asset, we're going to have to pay $425,000 in taxes. So the after-tax salvage value is just the difference between those two. Right? We can summarize that as we have done many times, right? Over the life of the project to come away with our cash flow estimates below, year 0 through year 5. Okay. The new thing that we can do now is come up with our discount rate, right? So since the risk of the project is similar to the risk of the whole, we can use WACC. So we'll come up first with, on the equity side, we get its market value, which we'll use for our capital structure weights, $35.6 million. Required return, we're going to use CAPM again, come up with a cost of equity of 14.8%. Right? There's the debt side, market value of debt's $24 million. All right, required return, we're using our bond valuation equation, plugging everything that we know. Again, being careful, we use our calculator because it's semi-annual. We have to double whether it gets spit out. We get a cost of debt pre-tax, 6.87%. We get our capital structure weights. Market value of debt, $24 million. Equity, almost $36 million, so a total of about $60 million. 40% from debt, 60% from equity. We plug it into our weighted average cost of capital formula, right? Remembering to include the effective taxes, spits out 10.66%. And then we bring it all together in our NPV framework, right? We have our cash flow estimates, and that 10.66% becomes now our discount rate, right? We plug in chug, spits out $5.65 million. Given no additional information, we would say since the NPV estimate is positive, we would recommend building the manufacturer. So now we have all the tools to come up with the cash flow estimates, at least rough estimates, come up with a first pass discount rate, right, and then put it all together to come up with a net present value calculation. Okay. Any questions about that? Lots of practice.
Just so, like on Friday night, I'm not freaking out. That yellow in the brackets, that's just a tag that it should be in yellow, correct? And it doesn't mean anything to the equation?
You can take it for any way.
Yeah.
Yes, that just means yellow on the calculator. That's right, yes. It means yellow on the calculator. Yep. Oh, you know what? That's because this group all uses the same calculator. When I typically teach this, we have two different calculators in the class. One's a TI, one's an HP model. In the HP model, the one you do not have, has this yellow second function. And so these are your guys' steps over here. These are their steps over here, which I just didn't update my slides. Same thing. So, but yes, that's what yellow means. The first question on the exam, what's yellow?
That's it, I'm leaving. It's been fun, thanks guys.
All right, so that's all I had. Again, it was fairly quick going through today because most of this was review. All right, the only really, again, was just pulling it together with the capital structure weights. I gave you an extra WACC problem. There are extra practice problems in chapter 13 for you guys to work on. So I'll let you guys continue to practice on this. At this point, it is, the more practice, the better, I think. But I do want to open up to any questions that you guys have about the final exam. I can tell you it's going to look very much like the midterm in terms of stylistically look like that. Same rules are going to apply: open book, open note, open calculator, open Excel, not open friend, not open phone, not open internet. You only have access vis-a-vis the computer to Excel, but no internet searches. It's going to focus on the material since the last midterm, right? That's going to be the primary focus. But I do reserve the right, it is technically cumulative, I do reserve the right to come back to big picture issues that we talked about before in the midterm or on the last one. So things like I could ask you to calculate an NPV, I could ask you to calculate an IRR, I could ask you to move cash flows around, right? So big picture stuff like that, I feel very at liberty to. But we've had plenty of stuff since the midterm, things like cash flow, we've done all our cash flow calculations, we've done bond valuation, we've done stock valuation, we've done calculate a discount rate, the risk and return, both historically, means and standard deviations historically. We've looked at expected values going forward. So there's been plenty of material we've covered since the last midterm that will be the primary focus of the exam.
So you think like 60-40, 70-30?
I don't want to time myself down, but I probably more like 80-20.
I can tell you the WACC, I don't know what to do with it afterwards.
So, are there any logistical questions about the exam first off?
On behalf of Luda, I'll ask, what's on it?
What's on it?
She left me a note.
Best way to study to kind of just work through the homework.
I think, yeah, like I said, work through the practice problems, look through the notes, again, because there'll be both quantitative questions and some conceptual questions on there. Again, the more efficient you are, again, you have the book in front of you, you have the notes in front of you, right? But the more efficient you are at finding those answers, or the better it'll be. Look at the case. Think about the kind of the big picture things that came out of the case. Any problems that we did in class, anything like that, is definitely fair game.
If we are working through the problems and we just can't figure it out, who's kind of our deadline to try to get a hold of the homework?
That's a good question. So we meet next
Saturday at 1.
So I'll definitely, Saturday morning will probably be tough. But
We're busy.
I will, assuming the world doesn't blow up, I will Friday night. I'll check Friday night. I mean, I'll be checking all week, of course. So, but I will continue to check through Friday night.
3 o'clock in the morning.
I may not hit that. Maybe we can make the cutoff maybe like 10 o'clock or something like that on Friday night.
I really gotta know this.
I definitely get back. And again, the general rules apply. 24 hours, I'll get back. I mean, as soon as I try to get it as soon as I can, but 24 hours, I'll definitely get back to you guys. That's the undergraduates. Where the hell are you? I just emailed you. I pay your salary. I'll be checking up until Friday night. So that shouldn't be a problem. You guys feel free to email me. If you want to talk on the phone, we can do that too. That's perfectly fine. I'm also fine if you're working in Excel and you want to shoot me a workbook and say, this is what I've done. I'm happy to look at that and get back to you guys. If you're working pen and pencil, I'm happy, type it. You can take a picture of it, email me that. That's fine. You can type it up, send it to me. Just let me. I just want to know what you've done so I can then help point you in the right direction. What's not helpful to me is I don't know what to do about number 3. Right? I mean, you read number 3, you've tried something, I hope, on number 3. Just tell me what's going on, right? Like, most of these problems we at least can think about, right? You have the answers too, right? So, I mean, that's the other thing. So, I want you to understand what's going on so I can help you with that. All right. Any other questions about the exam itself?
Questions wise, like last time, 35-ish, or like
Something like that. Yeah, like I said, I think stylistically it'll look a lot like last time. Yeah. So length.
One question in
primarily
38
multiple
parts.
choice. One question. It's 100%. That's it. One question. It's like the old law school exams.
Why?
Or the law class we had for this program. One question.
I'm also happy to answer. Are there any content questions in terms of other than what's on the exam? Are there any issues I can help with in terms of problems that you guys have had with the practice problems, or anything else I can answer right now? Nothing? Okay. Doing dolphins. All right. Well.
Oh, is the dog case going to be on here?
Is it? It could be.
You said that about the tree case.
I don't know about that. One of the tree case, there was a question similar to the similar. Yeah, I will not ask you a question about the doll case, but using the thoughts from the doll case, I might take advantage of that, right?
Number 38, 1, MMDC, 2, DYOD. Defend your answer.
What does BYOD stand for?
So is there nothing else? Well, we have an hour left, but I think we've done a lot, and so we will leave it there. And like I said, if you guys have any questions throughout the week, please email me. The one thing I would ask you guys to do, I'd really appreciate if you could do the survey. If you guys could just take a couple minutes to do the survey, we really appreciate the feedback.
We schedule that right after we see work.
Yeah, you can't. Yeah,